Hey, everybody, good morning. Hope you're enjoying the flip flopping, the back flipping, the tremendous tariffs. It's a great word. It's a great word. My friend Gontis keeps sending me great quotes. I don't even have to do research before some of these videos. We have Stephen Horsford was in congressional testimony saying he helps Trump so much with his tariff planning. That is the trade representative from the admin, and Stephen Horsford was the congressman. Jamieson Greer was at this hearing at Capitol Hill, and it said, "Looks like your boss just pulled out the rug from under you and paused the tariffs," as Jamieson Greer was trying to talk about how he details this plan so much with Trump, and it's a team effort. They do it together, just like Howard Lutnick said that there were mountains of economic textbooks and PhDs thinking about these tariffs before they came up with that wonderful reciprocal tariff calculation, which is simply the trade deficit divided by imports. Here's another good one. It's the biggest increase in the history of the stock market. That's pretty good, Trump told reporters in the Oval Office. If you keep going, you're going to be back where it was 4 weeks ago. So yes, the stock market did bump on the news yesterday, the craziness. This is why it's great to be in Europe, right? I mean, we get to sleep through the madness of when Trump speaks and then just make fun of it the next day. Remember, guys, I'm the only one in the world that can give you this much Trump, stock, Bitcoin market, and Ukraine analysis at the same time. So it's a very small Venn diagram of people that can do that. Hopefully, we can put the pieces back together a little bit today and explain what's happening. Really seems like I have to do these market commentaries now, like every day, not just the broad macro trend line analysis like I usually prefer doing. All right, so I'm going to explain what happened and, in my opinion, what was the real reason why it was all called off, why all this tariff stuff was paused, why Bill Ackman, the Trump soothsayer and Twitter extraordinaire typer, went from apologizing for Trump, then apologizing for himself, then belittling Trump, then saying this was the art of the deal with such a huge comeback in the S&P yesterday. None of that matters. I'm going to show you the actual reason, what spooked them to the core. For that, we got to take a look at this chart. All right. So we're going to look at stocks and bonds. This is the brass tacks of what happened with the tariff issue, and it has to do with the dollar. It has to do with the strength of the dollar. So here's the S&P. All right, 80% of market value, roughly, in the United States is encapsulated by these 500 companies. Got this going back to 1950, which is really when the S&P started to be tracked normally. I do have further back databases, but it's not that necessary for this analysis. So wherever you are in the markets, let's go back to the 60s and the 70s, 50s even to make this point. Markets go up and they go down. And when they go down, what you're going to typically see happen is bonds go up. Okay, so this is that inverse sort of trade, or the safe haven trade that they talk about. It is markets are risky, all right? Because if you're an equity holder by nature, you hold stock in a company. It's nothing more than a stock certificate, all right? And by law, you get paid last. As an owner of a company, you get paid last. Who gets paid before you? bondholders. Bondholders are the same thing as debt holders or creditors to a company. That is someone who loans money to a company or to a mortgager, a real estate borrower. Creditors, bondholders, they get paid first. All right, so it comes back to the law. It comes back to just basic economics. They are different. All right, if you're a stockholder, it's different than a bondholder. All right, so stockholders get paid back last, bondholders get paid back first. In exchange for getting paid back last, stockholders have the opportunity to make more than bondholders typically. I'm going to try to illustrate that. And again, this will have exactly to do with the tariff situation. All right, because there's an underlying component to all of this, which is the strength of the US dollar. All right, so the S&P here back in the 50s through the 70s is in green. Let's actually go to like 85, something like this. Yeah, so start to move up here in the 80s, just before a big crash, actually. All right, S&P on the left-hand axis. Now I'm going to put on the right-hand axis the 10-year Treasury yield. Okay, here it is. Don't have it all the way back to the 50s, unfortunately, but it'll still help in this exercise. All right. So typically, what happens is if people are moving into bonds, they're moving out of stocks. Okay. But that is also a typical sort of gradual thing. Okay. So when we say the yield of the 10-year Treasury, all right, that is that's what's called the yield to maturity. It's the same thing as the IRR. It's compound annual growth. It's the way that bonds are priced. There is a price of bonds, which has to do with the face value, but that also incorporates the coupon and a discount. All that stuff, you wrap it up and you put it together. A bond yield will tell you the picture. So it's actually not worth looking at it if a bond is priced, if the 10-year is priced at $100 or $95 or $98, it doesn't tell you as much. You got to look at the yield to get the full picture. But what this says is at this moment, if you bought in June 1970 a 10-year bond at 7.9%, you'd have that locked in by the Treasury for 10 years. So at the end of 10 years, if you held that bond, you'd get 7.9%. Okay, it's a much better deal, by the way, than here in the 60s. If you had that same 10-year bond, you'd only get 4.2%. Okay, but the market sets the yield. Okay, this is a market-based thing, just like the market sets the value of the stock market. And what you can see here, generally, is they move in the inverse. Okay, 60s here, moving into the 70s, end of the gold standard. As bond yields go up, the stock market goes a little bit down. So another way of saying that is people are getting uncertain about the stock market, the trajectory of the stock market here. This was also pretty uncertain times. Vietnam War was still going on. Gold standard was collapsing. The Bretton Woods system was collapsing. The stock market was falling here. And look at that, 103 S&P going down eventually to 70. All right, at its local bottom. And yields went up from, as I said, in the 60s, they were 5%, went all the way up to 7, 8% in 1970. So what's happening, this is what's called the risk-off trade. People are getting out of stocks, getting into bonds. Nothing is unusual here. You see it happen here at the end of the 60s. You see it happen here in the 70s. This is also the very end of the Vietnam War, right here. Okay, full capitulation of the U.S. Stock markets go up. Stock markets go down. Bond yields go up. Okay, so, but here's the thing. Now, this is a classical sort of thing. All right, it's like if you're in bonds and you're getting a higher interest rate, it's better, obviously. So it's better to be in bonds. But the markets are sort of just doing, this is like long-term sort of smooth things that you might expect if the stock market goes down. people move into bonds. This starts to change. It starts to change as we get into really, really big debt markets in the future. The way that these yields will move compared to the direction of the stock market will start to change over the short term. Okay? So here we see just generally yields are going up. There's uncertainty. People are... what this actually means is the bond prices is going down. The yields are going up. Okay? But it's getting a better return as well. So what happens is even though people move out of stocks and into bonds, it's just a counter-cyclical thing. It's not that it happens all at once and people are rushing into bonds. That's not what this is like. That's not what's clearly happening here in the 60s and the 70s. These are just sort of normal old classical moves in the market. All right, but what you're going to see as we become more dollarized, and this is also very influenced by the Federal Reserve. Okay, we had rates top out here in the 80s. Okay, is also there's other things like inflation. Let me actually zoom in so we can see things a little bit better. Okay, now we're all the way up to, in 80, we're up to 15% on the 10-year. Okay, and short-term, no, I don't have that. This is Fed funds target. I'll get to there in a second. If you looked at short-term rates, they were even higher, getting close to 20%. Okay, so a full inversion of the yield curve, which showed a lot of uncertainty when short-term yields are greater than long-term yields. Okay, and that's another thing. Probably could have had a short-term market yield on this site or on this chart as well to get a fuller picture. But there were a lot of things going on here. Inflation, people were worried, so bond yields went even higher. Okay, and the stock market was at 135 here, and from basically here, from this point, we start to really see the opposite effect start to take place. Okay, so this is the point. Until this point, obviously you can see that the 10-year, and like all interest rates in the United States, they peak in 1980. Okay, so what I'm trying to say is this market is different. It's sort of just, obviously it's less data going on, and it's a more primitive market than today. Money isn't moving as fast, but the interesting thing is, as you have these little crashes in the markets, bond yields going up. It means bond prices are going down, but that's actually a cure. That's a cure. So when there is a hiccup in the market, the yields go up and people get more money in those yields. So it's actually better. It's sort of a natural cure. But what's happening is we have a rising interest rate environment. And so at some point, rates are just so crazy that people aren't really sure what's going to happen. This was Paul Volcker, was a big influencer of this, of the Fed. He also pushed these rates up because he wanted to bring inflation down. But my point is, it's a totally like sort of different world than what the world we're in right now. The world we're in right now started at this point in 1980. And this is Trump's world. Trump sort of thinks he could understand this world, and the dollar is the best thing, best horse in the glue factory, which it is. But from this point on, things start to change. Okay, now bonds become a safe haven, but only at the last minute. Only if we really don't think that our stock portfolios are going to hold. And I'll show you what I mean by that. Okay, so now we're in a falling interest rate environment overall. Okay, so the black yield, all right, as this yield falls, bonds get more expensive. All right, and notice the green line, stocks are getting more expensive. So the whole trajectory of the whole market is everything is getting more expensive. Okay, whereas before consumer prices were getting expensive, but that was like not acceptable to Volcker and the Fed at the time. So he raised interest rates during a time where stocks were also getting expensive, and this was just kind of seen as unsustainable. Also, we had this period of what was called stagflation, high inflation and high unemployment. But just a totally different market. That's the point of just showing you the 50s and the 60s and the 70s here. But once we get to this point, we get into this super bull of bonds and also just still rising stocks, a super bull of stocks as well. So stocks are clearly going up, all right, the green, and bonds are going up as well. All right, so here in reality, it was still, you could say the bonds were going down. It's true. Bonds were going down from here in the 60s to the 80s. But if you're a bond holder, the only time you really lose money as a bondholder is if the price of goods is increasing more than your interest rate. And that was certainly happening. This isn't an analysis in the price of goods, but you know, this was there were problems in the system and the Fed wanted to fix it, so they had to take rates all the way to the 80s. People hated Paul Volcker for doing this, but he probably did the right thing. But once we get to this point, there's so much ammunition now to solve any problem that might happen in the future because we're already at historical, this is like millennial high interest rates. The last time you would see interest rates this high would be in ancient Greece, Mesopotamia. Go back to Sidney Homer's History of Interest Rates to see that. I usually have the book on my desk. I don't right now. So now we go into a Super Bowl of stocks and bonds. But what will eventually happen is what's called the Greenspan put. Alan Greenspan became the chairman of the Fed at some point here in the 80s. I forget exactly. And, you know, all the way till the global financial crisis, of course. Then he handed off his baby of overinflated economies to Ben Bernanke. But let's just zoom in. We'll just do this step by step here all the way till today. What happened was the Fed had what they like to say a lot of tools in the toolkit. Okay, they could really juice the markets. And the Fed doesn't completely control the 10-year. They definitely control it, but they say that they don't. They say that they only control short-term rates. I'll show you in a second. I'm going to have the Fed funds target here. But the 10-year is it's the benchmark for the economy. You should always think about the 10-year for that because most projects just on a weighted average going to take something like 10 years to amortize. And if you want to raise debt for those projects, you want to borrow at this sort of a rate. But basically, the beauty for the U.S. economy at this point was he had interest rates at all-time high. The central bank, they had interest rates at all-time highs. And so the Federal Reserve, if anything would happen in the future where markets would sort of hiccup, you could start to lower interest rates. And so what's interesting is here was a market crash in 87. It was kind of the first time this was really tried, although I don't know that for sure, so I can't really say, but like this was obviously a big crash in 87. And so interest rates were going up. They're worried about inflation. And look at this one. It's a good example. The stock market is going up. Stock market's green. It's going up. The Fed's probably worried that it's overheating. So it's going to take the Fed funds up, all right, which is here. This is the one that they actually control, the target. So now the dotted line, the Fed's fund, I'm just going to put this on now. It's going up. 10 years also going up. But what happens here is a crash, all right? And this was the first time where sort of an idea could come that interest rates need to go back down. That means the price of bonds goes up and you can sort of bail out the markets. Okay, so it happens here. And again, these are such different days than now because money still is moving very slow at this point. But a huge stock market crash. All right, we're at 328, went down here to 225. All right, in October of 87. Black Monday is in there somewhere. And they cut interest rates from 7.3 to 6.8. All right, 0.5%. And the 10-year falls as well. Remember, when the yields of bonds fall, the price is going up. So now you have this sort of, rather than here in the 60s, where it's just sort of a normal thing, people move out of stocks into bonds, but it's not like bonds are also going down here, but that's a good thing in the sort of natural market is people want a higher interest rate to counter their risk in the markets. That's what was happening before interest rates topped. But now, and from the 87 crash until now, basically have the opposite. When the stock market crashes, bond yields will also go down immediately. And that reflects this strength in the dollar, strength in the Fed, the Greenspan put, which eventually became the Bernanke put. That's the big story that happened. Okay, so now you're getting this inverse effect of bond yields and stock markets, but it has a very different flavor than obviously when rates are in a general uptrend. That means bonds are in a general downtrend. Okay, so let's look at another one. The dot-com boom and bust. In the 90s, it didn't really happen. Remember, the World Wide Web started here. But here, we had Soviet Union ended, bond yields going down. This is also another thing why we're in a very different situation today. All right, notice that from post-COVID, it's over. In my opinion, the 40-year bond bull, all right, when yields go down, bond prices go up, the 40-year bull is over, okay? And Trump doesn't believe this. He doesn't understand it. He thinks that it's still on. Everybody's king dollar. We'll get to it. But here we are in this situation where the world is, the old world was collapsing. The evil empire was collapsing. But, you just had to drop interest rates to make things softer. And they were figuring this thing out. So look at, right when the Soviet Union was starting to collapse, the Fed funds was 8.3%. He took it down to 3% in the course of 2 years. That's a massive relief for the market. It's a relief for the market, and then the stock market will continue to grow. Again, money moves moving slower here. It's the trends are harder to see, but the stock market can go up and people can just be happy. Same thing here. This dollar trade started here in this was the Russian crisis. This didn't immediately happen it didn't really get to U.S. markets, but this was an Asian currency and a Russian currency crisis. Okay, happened in 97, 98. Look at that. Stocks go down, so do the bond yields. They move together. And here we can actually see that the market is ahead of the Fed. So it's not true that the Fed controls the 10-year completely. They don't. You can see here, the market is expecting the Fed to cut, and the Fed complies. The Fed cuts. And again, the dotted solid line, this is what the Fed sets as a target. They actually do this by changing the reserve. They print money. They're printing money when these rates go down, basically. So they're adding reserves to banks. They're printing money. That's why the rates fall. But the black line, the 10-year, is less influenced by this. It's certainly influenced, like I said, but it's not 100% influenced like would be the overnight Fed funds rate, the actual rate that banks lend to each other, or the one-day T-bill or the 30-day T-bill. They would be more correlated to the dotted black line than the 10-year. But anyway, it's not a whole exercise in the yield curve. I'm just showing you what the market starts to expect. Market starts to expect the Greenspan put. Things get uncertain in the stock market, the green, yields also are going to come down, and the Fed's going to comply too. It's also going to bring yields down for short-term yields. All right? So it's an interesting pattern that starts to occur, and it all is because rates were here, 15% in 1981, the 10-year. Short-term was even higher, but I don't have the Fed funds target for that. If I, like I said, short-term overnight rates, they were 20%. It was a full inversion of the yield curve, which is not normal. You want longer-term yields, like the 10-year, to give you more interest than the short-term. And that didn't happen, and that signals a crisis. That happened in the early 80s here. This also pricked the gold bubble. The gold bubble ended. Okay, so here we go. Through the Asian crisis, Now we're going to get to the dot-com, which actually took 2 years to fully bottom out. Happened somewhere here, right? 2000, late summer 2000. Look what Greenspan did. This was when New York Times started to call Greenspan the maestro. Let's go here. Let us zoom in. Okay, so the stock market is about to top. This is when I started to dip my toe in the markets, and a long time ago. The .com, pets.com, insane valuations, all that nonsense was ending. But what happens to bonds as stocks go down? The bond yield also goes down. And here, Greenspan, unlike what happened in 98, remember in 98, when the Asian crisis happened, it took Greenspan a second to lower, right? The 10-year told Greenspan, hey, you better lower short-term rates. All right. Unlike then, in the .com situation, Greenspan was ahead of the 10-year. Okay, so this was just pure Greenspan put. Markets get unclear, Greenspan will bail you out. This was a long bear, by the way, for the stock market generally. This was a 2-year bear. Even 3, I guess, 2.5-year bear. Say local bottom finished here in March 2003 at 804. It was 1,500. Okay. .com boom and bust. But look, we get to this phenomenon, and it happened from the 80s, is where stocks go down, yields also go down immediately. So you get this pile-on effect where the run to safety is immediate. It's just immediate. People want to go into bonds and out of stocks. All right, but when you go into bonds that fast, unlike in the 50s and 60s here, where you get time to sort of adjust and yields can go up, bond prices can go down, but that's actually a good thing. Here, you just want to go right into bonds. Okay, let me go back to the Zoom. Right here, the .com is about to collapse. People want to go into bonds, and there's so much money going out of stocks into bonds that bond yields fall. And by the way, like I said, this is exacerbated by Greenspan printing a lot of money. So the Greenspan put. So the dotted line is the Fed. Think of what the Fed is doing, money printing, and the black line is more the market, but still influenced by the Fed and Fed policy and dollar strength policy. Okay, so the dollar gets stronger as people get out of the stock market. And then, but the problem with this, remember, what does a lower yield mean, or a lower Fed funds target mean? It means more money is being printed. And this was indeed historically low. Look, he took rates all the way. Now let's just take out the 10-year. Okay, this is also another way to look at it. Rates were 6.5% just before the pop, went down to 1. So unlike some of these initial, I think I only had the 10-year. Where did I get this start? Started in the 80s. Even this looks like a huge drop, but this was 11.5% to 8%. 3 and change. This was a huge drop. Look at that drop. I'm looking at the Fed funds now at 6.5% all the way to 1. That's money printing. That's bailouts. But it's also people believing in the dollar, believing in the system. And why do they believe in it? How can you tell they believe in it? Yields go down. Yields go down with the stock market. So it's a different phenomenon than what happens in this situation, the stagflation situation. All right. And then this was obviously historical lows, by the way. Again, millennial lows, being at 1% just arbitrarily is a millennial low number. So we went from millennial highs at 20%, 15% on the 10-year. But again, if you looked at the Fed funds market, it'd be up closer to 20%. Millennial highs in 1980 to millennial lows before the global financial crisis. And then they're like, okay, well, we got a lot of inflation, price inflation we're going to have to worry about because of all this money printing. We're going to have to hike rates. They try to do it like systematically, single to the market. We're just going to raise. They start raising, a half a point, quarter point every quarter point, I guess, every quarter. Okay. Or every 2 months. And the European Union does the same. ECB Bank is doing the same, by the way, in conjunction with the Fed. So the markets have recovered. Bonds are now kind of sideways, but the Fed is trying to make sure we don't get too hot on prices. We don't go back into a situation like this in the 80s where they got to really raise rates. So, and this was, of course, what triggered the global financial crisis. It was this stair-stepping here. Just, you can see how arbitrary this stair-stepping is. It has nothing to do with the markets. It has nothing to do with price signals. It just shows they did too much here. They recognized it. They saw it in the inflation data. So they start to raise prices. And they do that. They're now higher than the 10-year, which is odd. This is an inversion. And usually when inversions happen, a crisis occurs. So a crisis occurred. All right. It was a huge one. Actually started in 2007. Here again, look how they had to follow the 10-year. 10-year starts to go down. That means bonds are going up, even while the market is still kind of going sideways to up. 10 years falling. They're now starting to drop. In 2007, Bear Stearns was bailed out, all the stuff here. Mortgage subprime hadn't fully fleshed out. Obviously, that happened in 2008, but there were signs. And the 10-year is ahead of the Treasury, the Fed here. The 10-year Treasury is ahead of the Fed all the way till here, and then, the rest is history, as they say, just bloodbath. They eventually go from, again, a crazy spread. In 2006, 2007, they had the Fed funds at 5.3%. That's probably 5.25%, but I should have taken it to 2 decimals. Within 2 years, it was 0. And then they did this stupid thing where they had the Fed funds now at a lower bound and upper bound. I'm showing the lower bound. It was 0. Interest rates went from over 5% to 0%. 500 basis point drop in 2 years. Now the dollar trade, the dollar carry trade is still on. We want dollars in the midst of market uncertainty, okay? So the stock market here was 1,500 points. Again, similar .com number, collapses to 683, so over half. Actually, it was 666. I don't know if I caught it. It was 666 on March 9th, I think. Yeah. Closed, I guess, 677, but it did hit 666. All the numerologists love making little things like that. I didn't come up with that. I just heard it enough times. So as the market crashed, yields still go down. All right, yields still go down. People want that safety in the dollar. So people are buying bonds. They're buying dollar-denominated assets, okay? Then we try to work it out. We have a lot of stimulus, whatever. I've talked about this 1,000 times. Same problem, by the way, even before COVID. So we have this sort of mixed thing here. There probably would have been a crash anyway in 2020, but we had COVID. And so it muddies the water. Clearly, we're on the same arbitrary stair step, try to stop all the inflation. And the market caught it. And you can see already in 2019, as yields are going down here, the market is getting a little bit spooked. People are moving into that safe haven trade. But COVID muddies the waters. Anyway, the point is, it's just like before 2008. This was just arbitrary. They're trying to fix their mess and whatever. But still, the point remains that all during this boom in bonds, from this peak to here in COVID, the dollar would have a safe carry. You would move into the dollar. Yields would go down when the stock market goes down. So the stock market crashes here, all right, 2018, sorry, a little bit, and yields also go down. Stock market crashes here, yields go down. There's also a repo crisis here. I'll talk about this. yields go down. Well, they go up briefly during the repo crisis, but eventually they go down. People want dollars. And then off to the races again. Money printing stocks go up. And eventually they know they have to raise interest rates to stop all the inflation. Brings us to today. Brings us to what happened with Trump. This was a very scary moment for Besant. I had heard the rumors, perhaps you saw as well, that he threatened to leave if Trump was going to leave the tariffs on. It's about the dollar. The reason Trump put the pause on is about the dollar. Okay, so again, we have this arbitrary stair step back up. They just, of course, the Fed has no idea what the actual interest rate should be. They're kind of following the market too, right? So let's take off the S&P. Markets anticipate a rate hike, so bonds fall, and then they actually hike. They fall more, actually hike. But, the Jackson Hole speech was happening here. Everybody knew they were going to raise rates, so the markets went up. And then they go beyond the market. We go to an inversion again, an inversion in the yield curve. That means, again, short-term rates are higher than long-term rates, which is a problem, usually signals a financial crisis. All right, and we've been that way until here. Now, Trump would have liked to just see this get back to normal. Let's keep short-term rates lower than the 10-year and lower. Okay, but this is the issue all the way till today. It's April 10th. Okay, it's April 10th. Let me zoom in. All right. We have yields go down and then yields go up here. Why could that be weird? Let's take off the Fed funds. Doesn't matter. This is the point. Why could this maybe be weird that yields go up here in the last couple days? Why did yields go up? Especially when the stock market went down. All right, I got to zoom in to actually show what was happening. This happened in the course of 3 days. Look, stock market crashed. If it was a normal situation, and again, normal I'm not saying is good, but a normal central bank bailout situation, Greenspan put situation, stock market crashes as it did, all right, because of Trump's blowhard tariffs. Yields should also go down. You should have that immediate injection of safe haven liquidity. People see that the stock market's getting risky, go into bonds, further compress the bond yields. All right, raise the price of bonds. Remember, it's an inverse relationship. Raise the price of bonds, compress the yield. What happened to the 10-year, the sacred main benchmark dollar 10-year treasury yield? What happened? It goes up. It goes up. I hope I'm being dramatic enough for you. This is, my stupid Zoom thing is annoying. This was the problem. The market 2 days ago was even going down more while yields were going up. This was the scary thing. Yes, they both finished up a little bit yesterday. Here was Trump's pausing. Okay, so the markets went back up. But ignore that. Let's even zoom in just to here. Right, can I do it? This is the thing. This is right here. These days. April 6th, 7th, 8th. This is not art of the deal mastery. This scared the bejesus out of Besant. You have weak stock markets, turmoil. Nobody knows what to expect with the blowhard in the office. And the safe haven play doesn't hold. So Scott Bessent, the Secretary of the Treasury, has much more data than I have. What's happening here? Why are yields going up? Why are bond prices going down? Probably because China was selling some bonds. Probably. Could have been other players in the market. China is one of the largest holders of U.S. Treasuries. This was a break in literally 45 years of Greenspan put methodology and mythology of the safety of the dollar. This scared them tremendously. You can't have, it's not even that much, right? Okay, the yield goes from 4 to 4.3, but this is a decrease in the price of bonds as stocks are still falling. It means no one's going into the U.S. We got people getting out of U.S. stocks, and we got people getting out of U.S. bonds. What this did look like was back in the 60s and the 70s. Okay, but like I said, in the 60s and the 70s, this is sort of a more normal, it still was a turbulent time, but it was a market reactionary thing. Prices are going to go up, people are uncertain, so you got to demand higher bond yields while the stock is also lower. Okay, this is a pre-Greenspan put phenomena. That's what I was trying to tell you at the beginning of this video. It's just this was normal back in the day when people really didn't have this supremacy idea of the dollar. Remember, the gold standard was still on here. Things were uncertain. So yeah, bond yields can go up and the stock market can go down, but that's okay if bond yields go up because then, people are ready to, or they should say they deserve higher interest rates for a higher risky, stock market activity. But that's not what Greenspan, after Paul Volcker did the heroic thing of taking interest rates to, 15, 20%. The idea was always that the dollar, the Fed, they would bail out any uncertain market activity, just like they did, here after the Asian crisis, just like they did here after the global financial crisis. When the S&P falls, yields also fall in the 10-year. That was the idea. Same thing in the 2008 crisis. Same thing in COVID. When the markets fall, yields fall. Go into safety, go into the dollar. But it was literally Trump's madness over a couple weeks that caused this phenomena that I would argue you have not seen since pre-1980. There are other assets in the world. And okay, forget the raise here because this is after the announcement of the pause. You got to go here. This was it. This is really interesting in my opinion, and it's not over. It's not over. That's what I've been saying for a long time. This credibility is not infinite. The U.S. is still not as low of a credit rating or much of a credit risk as, say, some, Latin American countries with high unemployment, or Russia, all right, which has a terrible currency and a terrible military and at war invading countries. It's not that bad. But Scott Bessent almost stepped down as Treasury Secretary because of this action in the market. You got stocks falling, the green line going down, and the black line going up. Bonds also falling. When I say bonds falling, it's always a little bit confusing. I know. Bond prices falling, yields rising. It's the opposite of what you would expect. Here was a normal expectation. There's a normal expectation in these 2 days of the madness. Go into the safe haven asset, buy dollars. But this split right here, where the market's still going down on April 8th and yields are now going up. So that's the story. That's the reason why Trump did the 90-day pause. No matter what he says, that's the reason. They're losing control of the dollar hegemony. And you just can't bully everyone in the whole world, especially if the only person you want to really bully is China. Should have put one more decimal here on this axis for the zoom, but yields were 4.4% here, all the way back to 4.3. This was the reason. So very interesting, in my opinion. And, no matter what Trump says, he's got a credibility problem. There's, he's just going into blowhard mode. I don't know how these guys like Bill Ackman and Jamie Dimon, whatever, everybody knows that tariffs are bad. He said it during his campaign. Everybody knows that tariffs are bad. He's cozying up to dictators, Vladimir Putin. And if it is the case, like I said yesterday or 2 days ago, Rahm Emanuel's been making a tour on the shows. If you've seen him, whatever you think of him, he's absolutely correct that the credibility of China was way in doubt before Trump came in. Trump was riding a wave of getting angry at China because China had decimated the manufacturing base of Latin American countries, African countries, to the extent that there was anything. I mean, they were bullying their way into the marketplace with very aggressive terms. Certainly a lot of manufacturing prowess, but they were bullying their way into the marketplace. And nobody trusts the yuan. You'd rather have gold or Bitcoin. Trump had tailwinds there. He had tailwinds to deal with China. And he decided to take on the whole world because he's an egotistical maniac. And that just can't stand. Like I said, we live on the border of Russia here. Article 5 is now pretty much a dead letter for NATO. If Russia would invade, no reason to think the United States would come and honor their treaty obligations. So it's now up to Eastern, Northern European countries to stand together against the Russian terror. And Ukraine, of course, is doing the most. But you're now seeing it in the markets. This is I don't want to be too dramatic, but when, I think I understand this stuff on a pretty, moderate level. You hadn't seen this in 40 years. And it's clear. Look, guys, this if you would draw the line, just imagine drawing a trend line from here all the way to here. Or let's start it here to here. The trend line was always down. It's clear. Paul Volcker sort of locked in the supremacy of the dollar after 10 rough years of stagflation and getting off the gold standard and high inflation. Oil prices weren't secure. Saudi deals were being done here to ensure the flow of oil because the United States was importing a lot of oil. But the fact that he was able to prick the gold bubble, remember gold was flying high to $800 an ounce for 2 seconds in 1980. The fact that he was able to prick the gold bubble and reinstate that dominance for the dollar, they had a lot of room to work with, and they did it. They did as much as they wanted, let's say. Not as they could, but as they wanted for 40 years. No one, in my opinion, you cannot argue with, say, these higher highs here after COVID and the monstrous money printing and say that we're still on a downtrend. We're still on a downtrend from here. No way. I think from here, look, I've been listening to financial podcasts all through this. People were calling the end of the bond vigilantes are going to raise the price of interest rates here. All right, this was after already QE 1, 2, 3. Nope. They still had fuel in the tank to lower and lower interest rates. They got 40 years out of it. They went from historical highs to historical lows. Okay. This was how they did it. Sometimes behind the markets, as in, say, this case. Well, this is starting here. This is just the target. Greenspan's ahead of the markets here. Ahead of the markets here. Behind the markets here. Markets really started, especially the short-term rates, were really falling faster than the target rate. But that was it. 40 years. 40 years of doing what you wanted with the dollar, being able to just put a little bit more gas on the fire whenever stocks would fall. All right. And that would encourage stocks to generally rise. That's over. It's been over since 2020. Should be clear. We're in just like madness. Even though we're having, higher stock markets, we have higher inflation. And this little rise in interest rates to 5% from 0% has not been enough. The Fed is not complying with Trump. Okay, they have dropped rates a little bit, but their balance sheet's actually still going down. But really, the story is this. It was this. Right there. Now they both went up. This is as of this recording. That obviously the stock market hasn't changed since yesterday. Yield did compress a little bit. But this scared Scott Bessent right there. Stocks continuing to fall, yields rising. That's going to get interesting. I mean, the doom and gloomers would always say it's over. Like I was starting to say, it's over here, 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 here. It was over here, here. Bond vigilantes were going to come in, higher interest rates, higher interest rates. They didn't let it happen, but now I think we're at least at a sideways place. I don't necessarily know if we go back to 20%. And again, this is a millennial high number. This is just unacceptable to be even at that interest rate, just relative to normal incomes and calculations. I mean, how can you pay 20% per year on debt? 15% per year on long-term debt. Might not go back to that high of levels, but the bullets are out of the chamber. The Fed doesn't have anything left. I mean, they can. And that's why Trump paused the tariffs, stopped the market meltdown. But look at that little rise in rates right there in the black. That's what he didn't expect. He was thinking rates would go down. Lutnick was thinking that as well. Owning 5% of Tether. My normal commenters are quiet today. Let me know, guys, if you have any questions on this. But I think at best you have the Fed sort of staying strong, not lowering rates. Because again, if they lower rates, then you just get back into silly seasons of like silly valuations and everything else. We still have a lot of price inflation from all the COVID stimulus. So it's now a fight between the Fed, bondholders, foreign bondholders are like, why am I going to hold this bond if you're just going to tariff me on all my products? And U.S. confidence in stocks. Let's look at this. Let's compare with the Russian market. Russian market got a little bit of save here. I thought they would be active. Are they not active? Maybe I missed that. Russian market either is not collecting data or they're not active. Or they paused. Because the good thing is they're in a big decline in the oil price. That's hurting them, which I'll show. Good morning to the Netherlands. Venom. So if nobody wants to buy U.S. bonds anymore, it doesn't mean the Fed must buy it from the government as the last one remaining possible. I have a chart on this. I'll show it tomorrow. they do have room in the tank for that. Okay, so they like if you look at all the bonds in the world, the 37 trillion, right? That's what the debt is, publicly held debt. Uh, Foreigners probably have 20%, I think, something like that, and then the Fed has less than 20%, and that is down from over 25% during peak COVID. So they do have room in the tank there, and they can, and that will cause inflation, and that will again cause Bitcoin to rise. BTC for plebes, yes, thanks. I completely agree. Lutnick is not as smart as people make him out to be. He had no idea he owned 5% of Tether. Yeah. So Cantor Fitzgerald, which is the fund that he's running, I guess. They have 5%, and Tether's like the best business model in the world at the moment. But let's see if people still want the bonds. He saved it. Trump saved it. He saved the pure puking. But this to me is the incredible story, and I don't know how much people are talking about it or thinking about it, but the fact that this yield rose is wild. RV says, can't confirm, but on X there were rumors that it was Japan that started to flood the U.S. treasuries. Could be. Totally could be. Besant has the data. Besant has the data. And if Besant said, I'm quitting, then it would just like all hell was going to break loose. It could have been massive. I mean, it could have been unbelievable. Trump holds the tariffs and people sell treasuries. It's like, that could have been it. I do think it's very safe to say that we're now back into a bond uptrend. That means a decrease in the price of bonds, increase in the yields, something like this. So we're back down to these days. But unlike these days, like I was saying at the beginning, we have such fast moving money now and fast moving policies, and Trump can fart on the golf course and it can change markets. So way different than here. I wanted to see more about Moscow. If anybody knows why Moscow wasn't trading since April 9th, which is yesterday at 6:50 my time, I don't know why. Maybe they paused the markets. And there's the pump back from Trump pausing. So this is a good thing, at least. As a belligerent as Russia is, they are hurting, and they're hurting in oil, which I want to show now. Oh no, this is the dollar still. Let's show dollar, yen. Let's show the yen, yuan, month. Okay, so in this case, down is good for that currency. Okay, so these currencies are getting stronger. The yen and the euro are getting stronger. And then, as you've probably seen, the Chinese government has been inflating. They've been weakening the currency in light of all this madness. Could be that the Japanese, so I guess it was here. This was probably because of the change. It was probably here where the announcement was made. It could be that, the yen was getting even close to 2% on the month, which is big for a currency, and now it's back to only 0.75% better than the dollar. It could be that right here they were selling U.S. treasuries and buying yen treasuries, which I guess could increase the yen currency value for a time. I mean, that's what it would do, but you still never know about inflation from the Central Bank of Japan. They have a lot of it. So yeah, that's currencies. Let's put in Russia, just because I'm always curious. Interesting. Russia's well good on the month. Let's go 3 months. Much better. This is the Trump pump right here. So down is good in this case. Up is bad. It's a year out, 5 years out. 5 years, most currency is still weaker than the dollar. Again, this is why the dollar is best looking horse in the glue factory. Euro is the only one that's slightly better. And certainly the Swiss franc is as well. Yeah. And this is too long. I don't like this chart. It's too long, but just to show you. I know I showed this already, but right, keep showing it, but the weakness in Russia. Good morning, Gio. Very interesting stuff, in my opinion. I don't want that one. Here we go. Okay, so here's the change in the Fed's balance sheet. All right, this is a percent changes from 5 years. This is about $9 trillion in Fed purchases. And as you were saying, Venom, the if the Fed is the only one to buy, that is also going to be a problem for the dollar strength. Fed had over. I'll show this chart tomorrow. I don't have it ready, but the Fed was over 25% of all treasuries in outstanding was on its balance sheet here, and now it's under 20, I believe. I'll show it tomorrow. But that's not really what I wanted to do. I think I wanted to show gold and Bitcoin and stocks. I'm probably got to take this out. And let's go a month. God, what madness. Look at these gaps. These are gaps in the market, these jagged things. Which you don't want, obviously, in well-functioning markets. You don't want gaps between open and closes. He doesn't know what he's doing. This is not 4D chess. John Bolton has said it many times. It's one move at a time for Trump. It's one move at a time. It's wait and see. It's come into the office like a real estate developer. Ask your employees, what are we doing today? It's one move at a time. As of April 1st, the Fed reduced the runoff to $5 billion per month. How long do you think they can run QT with these high yields? Yeah. I presume you mean how long can they reduce? Yeah, oh yeah, sorry, run QT, quantitative tightening, not quantitative easing. Yes. It feels like liquidity is getting tight in the system, feeling it in Europe, also across companies with bankruptcies and hiring freezes. Yeah, completely agree. Let me see if I can pull this up. I don't think this is going to work, and it's not going to be might not be current, but is it this one? Okay, let's go here really quick while it loads. But yeah, I mean, it seems not good to me. We can show it. So to show the QT that you're talking about, let's just go back and show this in a percentage term. Here's the Fed. That's a year. So down 10% per year. Up 15% over 5 years, but clearly they're down. This was the Silicon Valley stuff. It is interesting that they're still tightening and they've sort of lowered interest rates over the midterm, right? That is an interesting phenomenon for the Fed itself. And so it does show you like they have some room to do it, right? They, on average, the market believed that it was the good thing to do. Like you could still lower rates while also lowering the balance sheet. Like, it's not like one has to go up. It's just on the margin, like you said, it's QT. But to me, I agree with you. I mean, I think it's getting very tight for them. Oops, where is it? Which one? This one. I just don't see how much longer this can go on. Let's see if this chart pulled up. All right, it pulled up, but this is not going to be great, and it's not updated. Yeah, and I even got a problem here, which I don't understand. Let me just go here. This is not a great. It's kind of screwed up, but the point is, this is correct. Ignore this bar. It's broken data for some reason. It was 33%. 33% when they were at 9 trillion in balance sheet. And wait, it might be the wrong number. What's the balance sheet now? Someone tell me. Yeah, this is wrong. It's actually completely wrong. Sorry. It happens sometimes. My numbers get messed up on the back end, and I have to. This is why I can't do all this stuff on my website. It's too hard for me to put it together. This is the wrong chart. I can take this off and this off, and it's roughly the federal debt, but the central bank ownership is not right. None of that looks good, by the way. I understand, and it's not good for the dollar. I'll update it for tomorrow. Thank you, RV, for the comments. Happy to help. I'm happy to do this. Geo Fed preps 2 trillion bailout as hedge fund trade implodes. You always come to me with the great stories, Geo. I need some coffee. So liquidity reserve for banks at the bottom in gray and black. Are you talking about this chart? This thing I have up now? I do have just, this is TradingView, which is great. It's a great value. I would recommend it. I don't have any sponsorship with them, but let's just look at this again. No, need this. Here's a more live interaction than my long chart. Right there. And then this was the rumor, right? This was the rumor that the pause. Look at this madness. This was the rumor that the pause was happening for the S&P. And then that rumor was false, and the 10-year kept rising. So this is a percent change. It's not the 10-year rate, but it's still the point is true. So 10 years been rising as the stock market has been falling. It's very odd behavior. Oh yeah. That one too I can show, but that is it's not that's like only a quarterly, because I have all the M3 stuff, and it only because that's such a lagging chart. Unfortunately, it's just because the data to compile that M3 I can only get quarterly. So that one I don't have it either. We can pull up reserves though. I can pull it up here. Let me do it here, and then I'll pull it up on my chart. Don't they have bank reserves? Huh. Just trying to pull it up on TradingView. Anyway, I'll get it tomorrow. For sure, and we'll have another day's worth of data. This is wild. This is a wild thing. What madness. Okay, I will. Yeah, I don't know. for the Federal Reserve is usually better than other central banks, so they should get the uh, Q1 date out in a matter of some weeks. But sometimes that stuff is more delayed than I'd like. Let's say. Let's see this back even farther. So this is another thing. Like, I don't want to get too carried away in my ideas if it's like if it's really a change, because obviously this is also an interesting. This is obviously a change in the yield, looking at trading view, and you know, um, a change in the yield. So the yield percentage is falling still, which is generally good, right, compared to when the market is falling. It's not like this is like way higher. The green. It's not like the green line is on a super up trajectory here over the year. Well, over 5 years it is. We get a 5 year. Let me do this here so we can actually see the actual yield. It's 2025. Let's go April 2020. All right. This is okay. So this chart is a change in the values of these things. And this does further actually illustrate what I'm saying, even though the real madness was just right here. But yeah, I mean, you got higher moves in yields, 500% higher yield. That means maybe it is the actual yield rate. No, the yield is 4.3. Yeah, it's a change in the yield rate. So yields were 0.7%, 1%, right? In 5 years ago exactly. Now they're 4.3%. That change represents a 500% change according to TradingView. And the S&P is only up 100%. So yeah, I mean, I don't see how this is not an indication of we are like full, like the bondholders are going to start to be more in control. And if the bondholders themselves are not in control, like we saw here, where the yield rises as the market falls, then that's a big problem for the dollar. Yes, it does. It does trade like Trump. Here's the Malay coin. Look at that. Oh, the Joker. Poor Malay. I like Malay. He had no idea what he was doing in crypto. Came in February with this coin. I think the market makers bailed out Portnoy, which was hilarious. They bailed out Portnoy for losing money in market making their Libra coin. That's down 82%. I do have Trump's I got a lot of lists here in TradingView. Trump pumps. Let's compare. Let's just look at all of them. 3 months. All right, Trump coin is down 80%. Melania coin 87%. So he's beating his wife, who hates him. Probably hates him even more for that. A little bit of a pump in his media company, down from like 60% to only 40% in the last 2 days, but still down 40% in the last 3 months. Tesla down 30%. Sol, which as we know is David Sachs and Co., Silicon Valley rigged coin. I don't mind if you trade these, by the way. I'm not one of these Bitcoin maxis that don't think you can trade. I mean, feel free to trade, but Bitcoin's a safe bet. And Tron, of course, Justin's son, getting, buying his freedom by investing in World Liberty Financial or whatever, which I can't get a good coin of that. For the World Liberty Financial, I don't understand the economics of it. You can't find the token. They have all these like wrapped tokens on Ethereum. I don't even know, but Tron is holding their own in the last 3 months. Tesla's still up 50% on the year. Not too bad. God, Musk must have been living high right here. December 2024. Anyway. Yeah, I guess I'm going to have to do stocks now, right, guys? If you like this, if you like seeing these charts, let me know. I'm not a trader. I'm not a day-to-day, moment-to-moment guy. I don't follow the news to follow what happens with stocks, but everything is just crazy. SPX 6900 meme coin. I don't have that one. I hope that's been good for you. Bitcoin and fart coin, the most balanced portfolio, Benham says. I agree with that. This is a good one. Oh, these guys. Bitcoin's great. And let's put in Bitcoin here. Bitcoin. Did I put it? Yeah, okay. So 5 years obviously crushes everything. The 10-year doesn't make sense to look at as a percentage here, but let's look at 3-month Bitcoin. So it's down, this is Malay. This is Malay's play into crypto as well at the same time. Bitcoin is down versus stocks, but again, as volatile as Bitcoin was 10 years ago, to me, this is remarkable. And it is interesting, by the way, that Bitcoin pumped yesterday with the Trump announcement. I don't think that it's super correlated with the stock markets, but I would say the fact that Bitcoin didn't completely crash. Yeah, it crashed a little bit more here than the stock market in February, after being a little bit higher here. I have more and more confidence the way that this news comes out, the way that reserve assets are being talked about in the media. I have more and more confidence in Bitcoin every day, in light of just the current environment. Yeah, basically. I mean, what's the, hold on. We'll go back to the percentages of Trump coin. BTC for Plebe says Trump coin launched at $8. Wouldn't that mean 100% of investors are at zero? You can go down to 90. You can go down to 90%, then 95, then 99.9. What's the price on Trump coin itself? Wait, did you say it launched at 8? Oh, was that the yeah, 0%? I mean, 0% gain. So 8 was like the launch price or something? Because eventually, the open, at least on TradingView, was $39, $40. But maybe that was their offering or whatever. Because now Trump coin is $8, but yeah, still down 81%. What's Gabblers? Still dangerous times, though. Very dangerous. I mean, I always like to bring it back to security. I wanted to look at oil. So Brent, this is the European oil, which is better than West Texas because it has to cross the seas and everything. Let's take off Libra because that's just okay. So this is very good. The fact that this is down, obviously it's good for people at the pump. It's not good for Russia, but it's good for the free world if that keeps falling. And Saudis could help us even more by pumping more. And interesting, the United States doesn't need, the United States exports oil now, very different than here. So this is a very oil-induced crisis here. These big drops in the stock market. This one, especially, from 72 down to 75. This is Vietnam ending an oil-induced crisis. Now, that's a good thing about the dollar. At least we have, fracking. We'll keep tracking this, guys, but I can't stress enough, at least my understanding of markets, my understanding of what these things are supposed to mean. Trump does not have the power that he thought that he did. Where is I have so many different lists here, I can't even keep them straight. Let's look at the change in the federal funds. The repo, we can show you the craziness here with the repo. 10-year. Let's just look at those first. All right, so let's look at, why do they? Sometimes they take away my windows. Like now I don't even have a day I don't understand that. Oh, it's because of one of these is not updating. That's the reason. This one's from February. Which one? It's probably the repo. Let's see if it was. Is it the repo? No. Is it the Fed funds? The 10 years delayed? Huh. I take off the 10 year. That's weird. Okay, so I don't know what's happening with this. It's annoying. That's why I like to chart this stuff myself. Has to do with the time frames, why I can't get some of these 1 day, 3 month windows. Let me take this off. Let me put gold, Bitcoin. Let's put the dollar index. That'll also help. So dollar index, another way to track the dollar. Let's look even pretty narrow first. 3 months down, which makes sense, right? Yields have been rising. Bond prices have been falling. Dollar falls. Less interest in the dollar. At the same time, gold is rising, which is counterintuitive. But again, not everybody who wants dollars wants gold. More people want gold than want dollars for sure. And Bitcoin, volatile Bitcoin still. Volatile Bitcoin, I understand that, but that's... It would be interesting to run some long-term correlations of these things. Bitcoin is still volatile. You still got to be able to withstand those Maalox moments. But, down 11% in 3 months versus up 15% in a year. Yes, gold has had a great year, surpassing Bitcoin after this drop in February. But then, as I always like to show, we just destroy everybody. Even if you hold this out from, 2 years, 3 years typically. Certainly 4. And then for the ultimate fun, get the all-time percentage, 1,000 million billion, 6.5 billion %. Gold only gets 14,900. That's fun. They got gold going back to 1883 on TradingView. I do recommend this platform. Anybody have anything else to see? I would say I'm getting there for the day, guys. But I'll update this tomorrow, and I'll get the bonds. The percentage of U.S. debt that the Fed owns and foreigners. That'll be an interesting thing to see, because we can see that pretty much in real time, and that's a good metric. So we can see what's changed in the last couple weeks. But that's my big dramatic reveal for this video, and I would just say pay attention. Maybe it was a blip. Maybe we can move sideways for a while, but you do not want to see yields go up while the stock market falls. At least Trump doesn't want to see that. Certainly Besson doesn't want to see that. How high can BTC go? Sky's the limit, my friend. No, I mean, I've said it a lot. I don't think you're going to go. I think in a safe, non-crazy world, let's put every 10th. Don't rely on something that's more than 2x the trend. I think that's the safe way to look at it. So here's the rainbow. Smooth in the future, jagged in the past. But again, this has been pretty smooth from 2016. So it's a very good trend. That is this trend. And if you look at where we are now, and again, unfortunately, this is delayed. Well, only one day this time. So it's 82,000, which is up from that dip on April 8th, 76,000. Good buying up, I think. Look, I mean, we're right on trend. Nothing to worry about. We're up from when Peter Zion was saying it was $17,000 overvalued at $16,000. And so I think, based on prior results of these 4-year booms, I think you definitely get above the 90th percentile. It always happened, always. And so that's 2x the trend is the 90th percentile. So if we take it out to 2025, $125,000 Bitcoin, $250,000 peak is the 90th. Anything above it is a bonus, but I wouldn't count on it happening for more than a couple days, weeks, months, if we're lucky. And I do not buy the argument that we're moving into like a sort of stable, especially with the way that things are happening in the markets right now, right? I don't buy the argument that we're moving into this sort of stable ETF, financial institution, sort of stable market, not having these huge peaks as before. I think we're going to have, it may be, more rounded like it was in 2021. It may not be that huge blow off where we almost got to the all-time percentile in 2017, which again, that's something that is like, here the trend was $3,000, the price was $15,000. This is actually, it was $20,000. So that means that the multiple was something like 7x on intraday. And look at the 100th percentile multiple, 7.8x. There's never been in the history of Bitcoin the price hits 8x the trend. Easy way to think about it. You're never going to be 8x the trend. I think it's impossible. I could always be proven wrong. Could be hyper Bitcoinization actually happens. I don't think the world works that way. I think these longer term trends make sense. So 8x is impossible. 8x the trend, impossible. Let's just go out to mid 2026. $1 million here, I think it's impossible, at least during this cycle. But 2x, very possible. That's 300,000 out to June 2026. If we take it to End of 2025, 2x. Again, that's number nine. Number nine, 250,000. I think that's easy. And then, honestly, anything between number nine and the all-time basically is a bonus. I wouldn't count on it. Yes, a weak dollar is 333 BTC for Plebe says. I think that's possible. Market likes those wild numbers, like it did for 666 in March 2009. Yes, Geo, a weak dollar is good for BTC price, but as I've said many times, what you're seeing here is adoption more so than purchasing power. Yes, purchasing power is a component of it. Yes, it reinforces the narrative. But if I take away, you just look at the edge cases here. The Greeks were in disaster here in 2011. Why didn't Bitcoin explode? Because it wasn't adopted. Not enough people knew. Cyprus was confiscating depositors' money here. Why didn't BTC explode? Because it needs more time to adopt. I'm old, but I'm not that old. But what I can tell you, and again, this is where, to toot my own horn, I'm not going to sound like a doom and gloomer or this time is different sort of thing. All these podcasters, all these guys I've been listening to since the global financial crisis, since Bitcoin's been around, they've always said, this is the day where the bond vigilantes take over. This is the day where interest rates are going to shoot up and markets are going to crash and gold's going to go to 10,000. Never happened. They were wrong. They were wrong for 10 years, 10 plus years. Now, I think it's safe to say that the bond vigilantes are in control. People are demanding higher yield no matter what the stock market does. But same thing as before. They're not demanding enough, because when the shit really hits the fan, usually they both go down together, and that didn't happen here. Scared the bejesus out of Scott Bessent. So, long-winded way of saying, Geo, a weak dollar, is it good for BTC price? Yes, but I think that is more on it's an exacerbatory thing. It's good when inflation rises. Yeah, BTC can go a little bit higher, but I think what you're really seeing here with this beautiful power curve is just the network is being adopted slowly but surely all around the world. And it's we're very lucky. We're very lucky to have this opportunity, because I think once you get out probably two halvings from now, even though it's still a huge percentage each year, it's going to be like 40% and falling each year. It's 45% last year, the compound growth, 42% this year. That's the slope of this curve. So still way better than any market. I do think that probably two halvings out, at that point, when we're at $1 million Bitcoin, we could be close to that $100 trillion BTC market cap. And if we're at that $100 trillion BTC market cap, then finally the denominators start to shift and people start to think, okay, actually I need to be thinking in terms of Bitcoin, not in terms of dollars. But that's a gradual thing. I think it's just, I'm not that old. I'm older, perhaps, than some of you guys, and seen some of these crises firsthand and heard all the pundits, going back to the .com, people saying it was a generational opportunity. Yeah. It's another thing. Lower prices are the cure for lower prices. Sometimes people just love the low price and eventually bottom out. So I don't necessarily think it's like the end of the dollar. That's what the newsletter writers would tell you. I'm not saying that, but it's just a long-term trend stuff. And am I confident that Bitcoin will be the global reserve currency? Yes, at some point it will be. But it's not happening a week from now because of Trump's tariff policies. It's not going to happen. Why do they say it's the end of the cycle next year if we haven't even started lowering rates? You mean? I think. Uh, you mean the Bitcoin cycle? I presume you mean the end of the Bitcoin cycle, and that's just a 4-year thing. Okay, it's based on the nature of Bitcoin. The emission, that is, the new coins drop on average 16% per year, compounded, which works out to dropping by half, by halving every 4 years. That's 16% per year, compounded negatively. So it just works out that we see these peaks roughly every 4 years. Everybody knows it in Bitcoin. Everybody's observed it. 2009 went to 2014, 2013, and 2013 went to 2017. 2017 went to this interesting double top, but still was 2021, and now we're in 2025. So people think that it's now. People think this is the year that we should see the overextension beyond trend, and I do too. I do too. And I think it's agnostic to interest rates. So what I really need to show probably next time is a chart from Bitcoin, right, which is here, and show none of this stuff, but show this. So this is why I think, this is why I'm not worried about interest rates one way or the other. This is why we are lucky, no matter what the White House does or anybody, we are lucky to have the opportunity to buy Bitcoin. Because look, Bitcoin was being adopted here, it topped out here. All right. And then government started to take away the punch bowl here. Bitcoin hit an all-time high. Okay. Then they put the punch bowl back. So this one did coincide. More printing of money occurred and Bitcoin peaked here. But now it's sort of the opposite. Yes, it's from the local top, they're going to take away the punch. But actually, as I said, and is interesting, even though rates are falling, they're doing that QT as was that you, Venom, or BTC for plebes? Yeah, Venom said they're still doing QT and rates are lowering, so it's a little bit different in and of itself. But that's because they printed so much that they can, on the margin, still lower rates and take the balance sheet down, and markets are fine with that. See, they went way ahead of the markets. We've been in an inverted yield curve since that Jackson Hole speech that Powell gave after the massive COVID stimulus, because they knew that was an extraordinary situation with COVID, so they really wanted to make sure. Powell was trying to be like Paul Volcker here. He really wanted to be strong, you're going to be able to trust the dollar long term. And so markets are a little bit forgiving here, letting him drop rates while he also takes the balance sheet down. That's working for now, and but yields are rising still. Probably, it's very interesting time right here, and this one in particular. This little boop. So, all right, guys. If anybody has anything else, let me know. Otherwise, I'm going to sign off for the day. I'm not an 8-hour hardcore streamer. Got some other work to do, but I enjoy this. Speaking with you guys. It's fun. Stay the course. It's not even about staying the course. It's just about not worrying. It's you're going on a different course. You have an escape hatch from this madness, from whatever the signposts are supposed to tell you, and the tea leaves, and all of the. That's why I love Bitcoin, man. It's like This is fun to look at all these numbers, but God, it's like crazy sometimes, right? And um, it's just hard to, it's hard to keep track. But once you can draw that trend line on an asset that's never been seen before, and you see that it has a remarkable trend line, then take massive comfort in that. if you're gonna sell some coins to buy that apartment, then you might be regretting that in a couple of years. That could be the most expensive apartment that you've ever bought. It's been said by many. I'm not saying, but look, a lifestyle thing is a lifestyle thing, and if that's what you want to do, I mean, obviously, by all means. You can be like Sailor and have your Bitcoin and then draw a loan from it, but the rates are too big. They're too expensive for that, in my opinion. I like it. It's good to be modest. Stay humble, as they say, right? Stack sats. All right, guys. Thank you for watching. I'll come back tomorrow with some updates, and we'll see what Trump says today. Will be fun. See ya.